Good afternoon. Good afternoon. It's Monday, the 18th of August. Welcome to another edition of Monday Market Picks. My name is Silan Wickramasinghe. I'm the head of research for Maybank Securities here in Singapore. Markets are modestly up. There wasn't too much fireworks from Trump and Putin over the weekend, so not much major geopolitical escalations. Here at home, we had the Prime Minister's National Day rally speech last night. Singapore's prioritizing jobs and jobs growth ahead of the rising AI uncertainty. Also, there's a lot of new investments going into the north of Singapore, which ties in quite well with what we've been talking about, especially in terms of the Johor Singapore Special Economic Zone and helping the north of Singapore glow up. All this will keep market momentum positive over the medium term. And for that, we need to figure out which stocks to play. So today's overall show is dedicated towards stock selection. First, we've got Jarek, who's initiated a new high conviction opportunity plus stock, Sanli Environmental. This goes directly into that infrastructure spend that Singapore government is doing. So we'll hear from him in a little while. We'll also go over to Husseini, who's got his latest views on Singtel and StarHub, particularly as there's a lot more news flow in terms of industry consolidation, plus C as well after their very strong first quarter results. We then turn our attention to Plantations, a segment we haven't paid a lot of attention to in the past, but we think it's going to be more and more important as we go forward. So we'll talk about First Resources, Bhumita Mayagri, and of course Wilma as well. And then we've got some trading ideas from our chart guy. But first, let's start with Jarek. Jarek, welcome to the show. Now, you have initiated on Sanli. Can you give us a bit of background on what this company does before we get into the whole initiation story?
Sure. So basically, what Sanli does is that basically they are actually a pure local owned water treatment and maintenance provider. So basically, their customer is, I would say, mainly PUB, which represents about 90+% of their revenue, and they do the EPC as well as the maintenance for the new water plants, new water treatment plants, as well as the other treatment plants for Singapore.
Got it. Now, Jarek, the stock's actually doubled in the past 3 months or so, yet you're initiating with a buy. So what's actually driving your optimism on this stock?
Sure. I mean, if you look at the fundamentals, I think that their margins are likely to rebound strongly this year. So this is very similar to another company that we initiated on earlier, which is ISO Team. So margins from the old projects during COVID, because the costs all go up, so their margins that from the lower margin projects are all gone, and now this year the margins will rebound back almost back to norm pre-COVID level. So that will result in a surge in profitability. So if you look at numbers wise, profit wise, they did about 1+ million profit last year. This year we are looking at 6+ million, which means more than 200% jump just for this year alone. And if you look at order book, the strong their pipeline of project is very strong. I think this is the this is the first time they hit a record order book of 300 million as of July, and they are still participating in a few big order tenders, which we think that there's a high chance that they can win. One of that is the Changi New Water, which is 205 million. The other is a potential LTA contract that's another 300 million. So if you add them up, Sanli's order book could potentially hit more than 800 million this year. And for us, we are just expecting it to double to 5 to 600 million. So even at 5 to 600 million with a yearly revenue of 180 to 200 million, this order book can last them for at least the next 2-3 years. So with that, we do think that the outlook for Sanli is still very positive, and numbers wise, valuation wise as well. We are just pegging it to a 14 to 15 times, 15 times blended FY26, 27 PE. And for this business, it's tariff free. You don't have to worry about Trump doing anything. PUB will spend is likely to spend more than 1 billion annually. The project pipeline is there because of the national strategy to be self-sufficient on water and less from imported water from Johor. We think that all this will carry on, and Sanli will be one of the main beneficiaries.
Got it. So bigger order book, national policy as well coming in from border security, and I think also from the sustainability angle as well, because Singapore is trying to become much more resilient against climate change as well. So a lot of these things will feed into that. Now, Jarek, what would be the downside risks for Sanli right now?
Sure. I would say that downside risk would be project delays and also execution risk, and I think that is the main downside risk for them. But as of now, we do not see this to be possible because COVID is over. But yeah, project execution risk as well as the project delays, all these will eat into their margins.
Okay, got it. Now, since I've got you on the line, can you give us a quick take on CSE? I mean, they also released some pretty good numbers last week. Where do you think the stock can go from here?
So I mean, CSE's results were quite in line. Margins improved despite a 10% drop, in USD against the Sing dollar. So I mean, I think things looks good, and also I think that we are still quite bullish on it because the data center side they will likely be getting a lot of data center orders lah. So we think that this segment is something that they are very bullish on. So with that we believe that the prospects for CSE is bright, and also with what the Trump administration is doing in the US with more onshoring of factories, we do think that CSE will also benefit from this trend. So all in all, I think results looks to be good, and the second half numbers and strong order book looks to be on track. And now we are just waiting to see whether they can secure more data center orders, especially with the gain in traction on Amazon and a few other customers as well.
Got it. So for both of those reports, Sanli as well as CSE, you can get the more detailed report in our newsletter today. Thanks, Derek.
Thank you.
Now, let's turn to Hussaini. Singtel's announced some pretty strong set of numbers for their first quarter FY26, while StarHub's first half numbers were a little bit weaker than expected. Hussaini, what's your reading into these latest results?
Yeah, sure. Thanks, Ilan, for having me. This is a great question. Singtel had a great quarter with its earnings up 14% year on year, whereas for StarHub, earnings declined 30%, 30% on an year on year basis. Essentially, it boils down to Singapore consumer weakness. So for Singtel, Singapore consumer was weak, in fact, very weak, but it's a very small component of their overall group revenues. Singtel has a much bigger exposure to other markets like Thailand, Australia, India, and Indonesia. And over there in those markets, the growth was much better, much stronger. And the Singapore consumer is just less than 10% of Singtel's value. Whereas for StarHub, almost 40% of their revenues comes from Singapore consumer, i.e. mobile, broadband, and pay TV, where the competition remains very intense. And given the low price points, the revenues will decline almost 7 to 10%, 7 to 10% year on year. And also to note is that although the 40% of their exposure is to Singapore consumer, the exposure to EBITDA is much bigger. So given all these factors, there was a big weakness for startup, and the divergence startup and Singtel's performance on the earnings side.
Got it. Now you focus on this weak Singapore consumer, which affected both of these telcos and StarHub more so. Do you think this, with some of this consolidation that is happening, we saw Simba, M1, and also StarHub, taking over the broadband business of MyRepublic. Do you think with some of this consolidation that it'll ease some pressure on competition and it'll help StarHub?
Yeah, sure. So we do expect competition to improve on the back of consolidation. See, Singapore is a small city state, but had 4 mobile operators and several MVNOs, and that was exerting pressure on the competition side or on the pricing side. Now, with consolidation, this should improve. And even if we see the markets which had undergone consolidation, like India, Australia, Thailand, Indonesia, and if you see the competition after consolidation, all these markets have seen a significant improvement. Also to note is that in Singapore's context, the ROIC levels of telcos have declined significantly in the last 4 or 5 years because of competition. So for startup, their ROIC levels have declined from more than 30%, say 5 or 6 years back, to now around 10% or so. So a significant decline in ROIC because of competition, and with this consolidation, things should improve. Now, that said, startup has noted that they would be aggressive over the next few quarters in terms of competition, and that is linked to the fact that as M1 and Simba consolidate and then they go through network integration, there will be a time where their network will take a hit. I mean to say that of M1 and Simba. And startup wants to take advantage of that window and try to remain aggressive in the market. But after that, maybe after 6 to 9 months, we expect competition should improve and that should help everyone, including startup.
Got it. Got it. Okay, let's turn our attention to C Limited, which also saw their first quarter results coming in very, very strongly. You say they beat expectations across the board. What were some of the standouts for you?
Yeah, in fact, what I see is that they are firing on multiple cylinders, right? For instance, in the e-commerce space, their GMV or gross merchandising value grew by 26% year on year. The same had been in the range in the past, it had been in the range of 20 to 25%. So we see acceleration in the e-commerce business. Gaming business as well posted more than 20% year on year growth, and company has raised its guidance for that segment. And finally, the fintech business also posted 75% growth, 55% EBITDA growth, and 90% in the loan book expansion. So company continue to do a great job and continue to scale higher and higher. So, but the one last thing to note over here is that while the top line growth is strong and continue to remain strong, management noted that it has reached to a scale where they can grow and improve profitability at the same time. So this comment, in my view, stand out and underlines that we should expect a more stark profitability improvement from here on.
Okay. Now, I want to actually zoom in on the digital financial services business. You've said, in the past as well that, this is a business that's growing very, very fast. It's ready for prime time. Anything in these results that is supporting that conclusion?
Yeah, it is very much visible. See, their GMV on the e-commerce side grew by 26%, which is very strong. But in the fintech side, or the digital financial services business, revenues grew by 75%. So thrice the pace of their e-commerce business growth. And the loan book expanded by 90%. Okay. Even with all this strong growth, NPL ratios are also very low at just 1%. So that particular business continues to do, the financial services business continues to do, continue to post strong growth. Now, if we see the underlying factors or the growth metrics, they all are in the nascent stage, such as buy now, pay later. Buy now, pay later is just in the mid-teens in ASEAN. Similarly, the credit card penetration is also very low. So all these factors are helping the fintech business to deliver strong growth. And one last point to note over here is that among all the fintech players, I am of the view that C Limited stands better, and the reason is that the Shopee ecosystem. So half of the revenues comes from offering buy now, pay later to Shopee consumers. And the same consumers, depending on their credit history, they offer cash loans. So given the Shopee ecosystem, it allows them to deliver better growth and capture the growth given the ecosystem benefits.
Got it. That's very clear. Thanks, Hussaini, for joining us. Now let's turn our attention to plantations. Now I know this is a sector that I haven't spent a lot of time on, but I think when you look at some of the stock performances, it deserves a lot more focus. The Singapore listed plantation stocks have done well, and our analyst Ong Chi Ting remains quite bullish on this sector. So first, let's look at First Resources. They had a blowout first half result. They crushed expectations for the first half. Core profits are up to $152 million, a 68% year-on-year surge, driven by CPO prices and a 23% surge in fresh fruit bunch output or FFB output. Part of this is from newly acquired assets as well. Is their downstream engine is also firing on all cylinders. The biodiesel segment is booming thanks to expanded capacity and Indonesia's B40 mandate. EBITDA margins in the downstream is 5.5%, nearly doubling on a year-on-year basis. So showing a lot of resilience in these volatile energy markets. Plus, there's a dividend yield of over 6%, and that still has potential to go higher. They've announced an interim dividend of 4.5 cents, and that's paired with a single-digit PE, just 7.9 times, so cheap by any standards. So we think there is an earnings re-rating story. Cheating's already raised his 2025 to 2027 earnings forecast by 19 to 23%, and he thinks that overall, you're going to see a significant more upside there. Plus, there was this ESG overhang on the stock. There was a long-standing RSPO investigation into deforestation claims. No sustainability violations have been found after this investigation. So we think the reputational risk is also behind them. So we are reiterating a buy call on that. Similarly, we like Bumitama Agri. Their first half results also beat expectations handily. Better selling prices should remain supported. Plus, we're expecting volume growth to hit about 5% in 2025. As importantly, this will enable the company to pay a higher dividend, which the yield's already reaching north of 7%. So we're maintaining a buy on this stock as well. Now on to Wilmar. I know there's a lot of our viewers have quite a lot of interest in this stock. We saw mixed performance in the second quarter. Operational resilience was there, but amidst a bit of a headline miss, there was a 13% drop in their core profits, driven by higher tax expenses. They delivered a pretty good top line. It was up 9% year-on-year, driven by volume recovery in the food and feed segments. First half revenue was up 6% year-on-year, though earnings came in a lot softer because of the elevated taxes. Also, dividend were cut, reflecting some of this Indonesian legal overhang. Interim dividends was reduced by 33% to 4 cents, which was attributed in part to ongoing legal and regulatory issues in Indonesia. This includes a $729 million cooking oil corruption case in which they have already set aside the cash, and a separate rice labeling probe that is still under investigation. We think the legal risks in Indonesia could pressure sentiment and valuation of the stock. Regulatory headwinds, especially Indonesia's palm oil sector, remains a key downside risk. These issues introduce uncertainty around potential fines and also reputational impact, and may influence Wilmar's operational flexibility and dividend payout going forward. On the other hand, there are some positive structural drivers coming out of China. Those operations are a bright spot. We saw volume-led gains and margins actually expanding for flour, rice, and oil seeds. Management has flagged continued Chinese demand strength for higher-end food products, offering a buffer against some of the weakness that they're seeing in the US and EU. So valuations are undemanding. We've reiterated a buy on this stock. Target price has been lowered to 365 due to earnings downgrades, but at 11 times PE, 6%-ish dividend yield, we are still maintaining our buy. But just keep in mind that you're going to have a little bit of, of a wait in terms of some of those catalysts to come through as his legal issues go out of the way. So with that, we stop on Wilma, and let's have a look at what our chart guy has. A couple of stock ideas. WHUR accumulate. It's had a bearish engulfing pattern, but our chart guy thinks the decline appears to have halted. The other stock is BUKIT SEMBAWANG. Renewed buying interest coming back above their 50-day EMA. So do have a look at these two names as we go in to the week. Apart from that, we got a few announcements. We got the Nordex numbers coming out later today. SATS results. I think a lot of people will be watching out for that on the 20th of August. China aviation oil on the 29th of August. And inflation numbers out on the 22nd of August. So do watch out for that. With that, unfortunately, we are out of time. Thank you so much for joining us today. Have a profitable trading week, and we'll see you next week.